Hello. I've been, since I made the previous video about using the slope of the IV curve to kind of predict good or bad performance in a market, I've done a lot more analysis over the weekend, so I figured I'd share that with you. So here's the average IV curve over a year of historical option data that I pulled from ORATs for a 50 delta SPY call. So the IV curve and thus the option price curve are in backwardation, meaning that the longer dated options trade at a relative premium to the shorter dated options. And then this makes sense. Typically less can go wrong in the short term, so the options have less value. So today's IV curve has a bunch more noise than the average curve, but it still has roughly the same shape. So the IV curve is still in backwardation. So here's an entire year of IV curves for the same 50 delta SPY call. So every curve represents a different day. You can tell that the curve is typically in backwardation. So those lines that kind of slope down to the left are more common. There's a few days where the market was in Contango, meaning that the shorter dated options were selling at a premium. So that means if the market is saying that there's a risk of like something crazy happening in the short term, then therefore the short term option price will go up. Okay, so I wanted a quick way to kind of tell the general shape of the IV curve and just define it with one parameter. So rather than doing a fancy curve fit, I just take the difference between the IV at 40 days for expiration and 10 days to expiration, and I define this as, quote, the IV slope. So here I'm plotting a year of IV slope data in yellow versus the SPY daily price in red. So this year has been a very strong bull market, and you'll notice that the IV slope is typically strongly positive, about plus 0.02. So the IV slope sometimes goes negative, and this correlates with times of heightened volatility. So I define a divider, an IV slope divider of 0.012, where anything above that I assume is in backwardation, anything below that is in Contango, even though it doesn't follow the strict sense of the definition of those words. And the significance of this particular number will become more apparent later. So here's a histogram of the a year's worth of IV slope data. So it's a skewed probability distribution. To the right of the most common value, the distribution is probably more or less Gaussian. But to the left, it's definitely fat-tailed. So again, I've drawn this magic IV slope divider number of 0.012 to kind of separate backwardation from Contango. So here's a histogram of the daily price change in the SPY, so the daily return in the SPY, from days when the IV slope was greater than the magic number of 0.012. So the expected daily return is plus 84 cents. It's pretty good. The outliers are mostly to the upside, which is pretty good. So standard deviation is $2.14. And in general, this is a good time to be long SPY. So conversely, here's a histogram of the daily SPY price change when the IV slope is less than 0.012. So the expected return is minus $1.17 per day, with a huge standard deviation of $4.50. So about 2 times the other case. So when the IV slope is below this magic 0.012 number, the returns are very volatile, and the outliers are skewed to the downside. So this is a bad time to be long SPY. So here's the daily SPY returns, but they've been color-coded to whether the IV slope is greater than the magic number of 0.012, and that's yellow, versus less than 0.012, which is blue. And you know, when there's blue, it's not like we only have down days. They're up days when we're in the blue range, but generally they're up and down. It's very volatile. So really, this is more of a volatility indicator. So if you integrate each of those curves in time, you get a cumulative return broken out for whether the slope value is less than 0.012, and that's yellow, or greater than 0.012, which is blue. So I've also plotted the actual SPY daily price in green. So the results here are pretty clear. There's a huge advantage to not being long SPY when the IV slope is out of that typical backwardation scenario. So for now, probably the most important graph in this video. So why is 0.012 the optimal division between the bullish case and the bearish case? So here I tested every possible IV slope dividing line, and then I computed the cumulative P&L for days that were above the dividing line and below. So kind of like the previous graph, but where I changed the dividing line. So the maximum P&L occurs at that magic 0.012 value. But that's not the important thing. The important thing is that there's really a fairly broad range, really between about minus 0.02 and plus 0.02, where you do pretty well. You wouldn't really be missing out much if you picked 0 as your dividing line, or minus 0.15. Now when your dividing line goes outside that wide range, the P&L goes to hell very quickly. So what this says is that you're pretty safe in this particular market, being long SPY at all times, except when the IV curve is strongly in Contango. So it means the IV slope is strongly negative. So it means that 10-day option IV is much higher than the 40-day option IV. So if this graph was showing, you know, huge swings in maximum and minimum over a short period, you'd be suspicious of overfitting. So put simply, that means that you know, a particular parameter caused us to kind of get lucky. There's no luck here. It's really a very simple attribute, one simple attribute, and there's a pretty wide range of success and failure. So that to me implies that it's a robust strategy. So when would the strategy not work? I think the strategy is probably contingent on the SPY continuing its crazy bull run, where we've got essentially extremely low volatility and long periods of just the market dumbly climbing upwards, and every once in a while there's a dip, and then it continues. You buy the dip and continues upward. You know, if the market trends to a volatile sideways pattern, or even a huge drop like we had with COVID, and then a heightened period of volatility for a while, you know, the conclusions might not hold. So just be forewarned. I can easily redo this analysis every day. It's not hard for me to do. So I'm going to continue in the future with the analysis. I'm very interested to see if the conclusion remains the same. Is that general dividing line still work? How does the maximum change? How does the general conclusions change? So anyway, I am trading this strategy for what it's worth. So at this very day, the IV curve is in backwardation. So what it says is you should be long. So I'm long. If the curve starts to move toward Contango, I might sell covered calls against my long positions just to hedge the delta, or I might get out altogether. So anyway, I hope you enjoyed this. Just a little more color on the previous video. Look forward to your comments, and see you later.